So traders, what exactly is candle range theory? Candle range theory, or CRT, is a trading concept built around a simple idea. Every single candlestick represents a complete trading range defined by its high and its low. When you break that candle down into lower time frames, you will notice that its high and low often act as turning points. That is not random. Those levels mark where liquidity forms. In practice, those turning points become key liquidity levels because they represent the highest and lowest price traded during that period. That period could be a day, a week, or even a 1-minute candle. In other words, CRT is not about predicting random reversals. It is about understanding how price reacts to clearly defined liquidity boundaries inside a single candle. With that foundation, we can combine this structure with smart money concepts to build high probability opportunities. Now, in its classic form, CRT works with 3 candles, and each one has a specific role. The first candle defines the range. The second candle creates the sweep. The third candle provides the entry. Let's break that down step by step. Starting with the first candle, its high and low act as the primary liquidity levels that future price will often target. Since those levels represent the extremes of that trading period, they naturally attract orders and stop placements. For example, in a daily candle, the high and the low represent the absolute highest and lowest prices traded that day. That alone shows how significant those levels are. Even without analyzing lower time frames, we can identify important liquidity areas just by observing a single candle. The upper boundary is called the candle range high, or CRH. In smart money terms, the liquidity resting above this level is known as buy-side liquidity, or BSL, because it contains stop losses from short sellers and breakout buy orders. The lower boundary is called the candle range low, or CRL. In the same way, the liquidity resting below this level is referred to as sell-side liquidity, or SSL, since it includes stop losses from long positions and sell stop orders. This concept can be applied to any candle on any time frame. What matters is how price reacts to those boundaries. Now, when the second candle moves above the CRH and then quickly returns inside the range, that movement is called a liquidity sweep. In many cases, once liquidity is taken on one side, price will rotate toward the opposite side of the range. The same logic applies in reverse. If price sweeps below the CRL and closes back inside the range, it often seeks the liquidity resting near the candle range high. However, there is an important condition. If the second candle closes decisively above the CRH, the CRT setup becomes invalid. In that scenario, the market is expanding, not rejecting the range. But when the second candle fails to close above the candle range high and instead returns inside the range, we can then look to the third candle for a potential short setup, with the candle range low serving as the logical objective. So trader, please remember that the ComLucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.